You mail the final mortgage check. The county tax collector and the HVAC repairman take your extra cash the following month. You build actual wealth by moving your home equity into dividend stocks. You sit at Tyler's dinner table with a half-eaten plate of food. A guest mentions paying off a mortgage versus funding a brokerage account. The table divides into two loud groups. One side argues for paying off the debt. The other side argues for investing the cash. Voices overlap and interrupt each other. You nod in agreement with the debate. 7 years before this dinner, you made this exact choice. You selected the payoff route, signed the final check, and sealed the envelope. The other guests avoid asking about the hidden costs of that decision and the personal sacrifices required to reach that milestone. You walk to the mailbox without company to drop off that final payment and process the end of a 7-year financial commitment. That solitary walk forced you to calculate the true price of your mortgage. You stood by the metal mailbox and watched a child ride a bicycle in circles around the concrete cul-de-sac. Your brain ran the numbers while the child pedaled past the parked cars. You and Hannah sat at the kitchen counter at 8 o'clock on every third Saturday morning. You drank hot coffee and opened the PennyMac dashboard on your laptop screen. You typed $2,100 into the digital transfer box. You clicked the send button and watched the funds leave your checking account. You ignored the transaction on certain weekends and focused on your breakfast. You fixated on the disappearing money on other weekends and stared at the screen. 14 months before that evening, Hannah returned from her Novant Health shift. She handed you her glowing phone screen before removing her work shoes. A physical therapy startup in Nashville offered her a new job. The position provided lower base pay and actual company equity. This opportunity carried massive risk and massive reward for her career. You both sat on the edge of the mattress and calculated the financial impact 3 separate times. The math produced the identical result each time you ran the calculations. Your monthly budget allocated the $2,100 for the house payment. The startup received a rejection text message from Hannah at 11 o'clock that night. You both avoided discussing the rejected job offer the next morning. A mortgage forces a specific question onto every single life choice. You must ask if you can afford the monthly house payment before taking other actions. 3 weeks after that night, you scrolled through Zillow on the couch. Hannah slept against your shoulder and breathed in a steady rhythm. Your phone screen displayed a new property listing from a saved search. The listing featured a 4-bedroom colonial house in the Peninsula neighborhood on Lake Norman in Cornelius. The property included a private wooden dock and carried a price tag of $2,350,000. You ignored the massive asking price. You focused all your attention on the wooden dock extending into the water. You imagined tying a boat to a house you lacked the funds to purchase. You closed the browser tab before Hannah woke and questioned your real estate browsing habits. You recorded your exact financial picture on the night you held that final envelope in your hand. You and Hannah earn a combined take-home pay of $128,000 per year after taxes and her retirement contributions. Your bank account receives $8,000 every single month. The mortgage consumes $2,100 of that total income. Your house holds an assessed value of $380,000 in Mecklenburg County. The county collects $330 per month for property taxes. National homeowners insurance premiums have increased for 5 consecutive years and average $3,000 per year. Your specific insurance policy adds $250 to your monthly household expenses. You pay for 2 separate car loans, weekly groceries for 2 working adults, gasoline for your daily commutes, monthly household utilities, and a Verizon phone plan that you intend to research for cheaper alternatives. You subtract all these mandatory costs from your $8,000 monthly income. You keep under $200 in leftover discretionary funds at the end of each month. That tiny $200 buffer separated a standard month from a financial disaster. You viewed this tight budget as a standard lifestyle choice. Your friends and family managed identical financial margins and shared identical stress levels. You confused a common financial situation with a secure financial situation. PennyMac mailed you a physical letter confirming your satisfied loan balance. You anticipated your monthly cash buffer expanding from $200 to $2,300. You expected complete financial freedom and zero restrictions. You planned to approve large personal purchases without consulting a digital budget spreadsheet. Your optimistic expectations missed reality and left your checking account exposed to sudden costs. You discovered your massive mistake when the mail carrier delivered your first expensive bill unrelated to your house payment. That single piece of mail destroyed your plan for extra monthly cash flow. The first Saturday morning after your final mortgage payment cleared, your phone buzzed at 8, 5:00 a.m. you kept the automatic bank transfer alert enabled out of pure habit. Lying in bed, you stared at the bright screen and experienced that familiar stomach drop. The panic lasted a brief half-second before your brain registered the empty transfer field. That specific dread vanished forever. Removing the monthly payment freed up a massive amount of mental bandwidth you sacrificed without realizing it. You recognized this new mental clarity during a Tuesday meeting with your manager. A guy named Derek runs the regional sales team out of the Charlotte office. He spent the one-on-one reviewing new territory assignments. He handed you a stretch of accounts in Ohio. Nobody wanted those specific accounts because they came with the worst quota and required the most travel. You heard your own voice say the territory did not work for you. The words left your mouth in a calm tone you failed to recognize. Half a year before that meeting, you would have accepted the assignment with a polite smile. Refusing any extra work in those days felt like tempting a fragile financial number you could not afford to test. Derek blinked, promised to find another opening, and moved to the next topic. You faced zero professional consequences. The employee burdened by a $2,100 monthly obligation would have spent the entire commute to his house agonizing over Derek's private thoughts. You drove to your house in silence. Scientists have a clinical term for this psychological shift, although your family avoided using the phrase around the kitchen table. Researchers publishing in the Proceedings of the National Academy of Sciences tracked individuals after their debts vanished. The researchers recorded a 25 percentage point drop in anxiety symptoms following the clearance. Carrying a massive financial obligation forces your brain to run background stress calculations the entire day. Eliminating that debt returns all that cognitive processing power to you. You lowered your personal financial floor by a full $2,100 in a single night. The floor represents the absolute minimum income required to keep your house. You gain benefits beyond simple cash accumulation from a lower baseline requirement. The reduced pressure gave you the ability to speak your mind to Derek. You turn a bad sales quarter from a catastrophic event into a minor inconvenience with a lower financial floor. Financial researchers identify eliminating housing debt as a primary catalyst for major life changes. People launch businesses, accept lower-paying passion jobs, or relocate across the country because the baseline risk becomes manageable. You experienced a mild version of this freedom within 30 days. This schedule change gave you permission to alter your routine instead of starting a massive enterprise. You picked up a leftover Friday shift teaching a fitness class at your local gym. Your friend Hannah had encouraged you to take the gig for months. You declined the opportunity in the past because the job paid pennies, and you had zero room for low-paying side projects because of your $2,100 mortgage. Removing the payment changed the math. You earned $50 extra each week doing an activity you loved. You shaped your Fridays the way you wanted them to look. For 3 weeks, your life felt balanced. You enjoyed a larger effective paycheck, total freedom of choice, and a quiet mind. You assumed this permanent state of peace defined the debt-free lifestyle. Then a letter arrived from Mecklenburg County. The local government reassessed your property taxes and demanded full payment by the end of the month. The tax bill had no connection to your old mortgage. Penny, your former lender, ceased to escrow and manage this specific expense. The county expected you to pay the entire balance in full. You stood in your kitchen holding the official notice and ran the numbers in your head for the first time since mailing that final check. You owed a significant chunk of cash for the final total. This tax bill taught you your first concrete lesson regarding the massive difference between paying off a house and achieving total financial freedom. The property tax bill cleared your savings account without causing any panic. You pushed the expense out of your mind and dismissed the event as an isolated occurrence. Tuesday afternoon arrived at the Harris Teeter parking lot, and your Honda Accord refused to turn over. A tow truck driver named Dale spent 4 minutes inspecting the engine bay. He confirmed the issue involved the transmission rather than a simple dead battery and delivered a repair estimate exceeding $2,800. He noted the final bill might climb higher once the mechanic placed the vehicle on the hydraulic lift. You stood next to the grocery carts and calculated your available cash. Your Fidelity brokerage account held $9,400 in liquid assets. That single balance represented your entire financial cushion. Your net worth calculator displayed a much larger figure on the screen. Mecklenburg County assessed your paid-off house at $380,000 that same month. Adding the vehicle equity pushed your total household net worth to $410,000. None of those paper assets provided any assistance while you stood in the grocery store parking lot doing the identical math you completed earlier in the month. You dialed the Bank of America branch on South Boulevard that evening. You opened your first checking account at that specific location during the week you moved to Charlotte. You asked the loan officer about opening a home equity line of credit, assuming your paid-off house held significant borrowing power. The representative explained the specific debt-to-income requirements and noted that approval remained uncertain despite your available equity. The bank needed 2 to 3 weeks to process the paperwork even under the best circumstances. Your mechanic needed to finish the transmission work by Thursday. Drywall lacks nutritional value and mechanics refuse roof shingles as payment. A paid-off house generates zero cash flow during an immediate emergency and produces nothing you can hand to a cashier at a retail counter. The asset sits there appreciating in value while remaining sealed off from your daily life. You transferred $2,800 directly from your Fidelity account to cover the repair shop. The transfer reduced your liquid balance from $9,400 down to just over $6,500 in a single afternoon. The screen illuminated your face while you processed the reality of the situation at the kitchen counter. You spent years funneling extra income toward your mortgage debt. Mecklenburg County gave you a clear title and an illiquid asset that offered zero help on a random Tuesday. Hannah walked into the kitchen and noticed you staring at the brokerage balance on your phone screen. You explained that the number felt incorrect because it failed to match the security you expected to feel. You visited South Park Mall later that week and waited for a table at Kura Sushi while the conveyor belt delivered small plates. You stopped in front of the Tyson's Jewelers display case and examined a Rolex Submariner date. The price tag read $10,150. You had zero intention of purchasing the watch. The luxury timepiece featured a date complication and occupied the identical mental category in your brain as your emergency fund. Both represented $10,000 sitting idle until a specific need arose. The only difference involved which item you could logically justify buying. You walked away from the jewelry case without making a purchase. The encounter clarified a specific financial rule for you. Money lacking liquidity remains out of your reach regardless of the paper valuation or the name printed on the property deed. You started wondering about the alternative path. You wanted to calculate the final value of all those extra mortgage payments if you had invested the cash in the stock market instead. You attended a cookout at Tyler's house off Providence Road on the 4th of July. You held a cold beer you barely drank and listened to Tyler complain about his new mortgage rate while standing near the grill. He purchased a similar house 2 streets over and locked in a 6.55% interest rate. He spoke the number as if it caused him physical pain, repeating his loan officer's claim that the rate represented a decent deal for the current market. You nodded politely while your brain retrieved the details of your own original loan from 2019. You secured a 3.875% rate and forgot you ever enjoyed such favorable terms. You spent the last 7 years treating that debt like a personal enemy. You threw every spare dollar at the principal balance to eliminate the loan early. You sat in your car with the headlights off before pulling out of Tyler's driveway and opened the calculator app on your phone. You and Hannah sent an extra $900 toward your Penny Mac mortgage every single month. That specific habit allowed you to finish a 30-year loan in 7 years. You decided to calculate the alternative outcome. You took that $900 monthly contribution and invested it in an S&P 500 index fund, averaging a 10% annual return based on decades of historical data. You ran the compounding math for the initial 7 years and extended the projection for 13 additional years to reach a 20-year total. You read a final balance of $683,000. You sacrificed that massive figure to achieve a zero mortgage balance. You traded a cheap 3.875% obligation for the comfort of sleeping slightly better at night. The bank agreed to accept fixed dollar amounts that lose purchasing power to inflation every single year. Keeping the loan would have allowed you to pay back the bank with cheaper dollars, while your $900 earned triple the interest savings. Your mind drifted to the medium Chanel classic flap bag in caviar leather that Hannah bookmarked online back in 2021. The retail price sat at $11,600. She never purchased the bag because the expense felt unjustifiable while you carried a mortgage balance. The math never involved avoiding indulgence versus buying a luxury item. The calculation centered on which asset compounds over time and which asset merely occupies space. You spent 7 years feeding the asset that sits idle. You drove home at a slower speed than normal while watching the streetlights pass by the windshield. Hannah asked about your mood when you walked through the front door. You told her everything was fine because you visualized the alternative timeline. You pictured the version of the last 7 years where you both maxed out your employer 401k matches. You calculated the result of putting $24,500 a year into those accounts like the IRS currently permits for older workers. You added the $7,500 IRA contributions to the projection. That alternate version of your life produced a final net worth with a comma and a new position. You felt zero anger about the past. You experienced the quiet weight of knowing the numerical cost of your previous decisions. You needed a new strategy to avoid making that same trade blindly in the future. You required a new method to finish the job. Hannah found you standing in the concrete driveway staring at your 8-year-old Accord like the vehicle personally offended you. You visited the Hendrick BMW website the previous night and configured a black sapphire model priced at $58,000 out the door. You convinced yourself the purchase made perfect logical sense. You eliminated your mortgage payment and freed up an extra $2,100 every month. You priced the auto loan and confirmed a 6-year term fit easily within your new budget. Hannah avoided arguing about the vehicle and asked a single direct question. She wanted to know where that $2,100 would go if you refused to spend it on a new car. You lacked a solid answer and recognized the core problem. You read enough personal finance material to identify the specific behavioral trap waiting for you in the driveway. Economists label this phenomenon Parkinson's law when it applies to household budgets. Spending expands to fill any newly available space unless you intervene. A massive percentage of homeowners pay off their mortgage and finance a luxury vehicle or remodel their kitchen. Those same people feel squeezed again within 18 months despite owning a nicer garage. Your spending rises to meet your income floor unless you stop the process intentionally. You and Hannah sat down at the kitchen table on Sunday morning. You used the identical table where you stuffed the cash envelopes and executed the Saturday transfers for 7 straight years. You decided to handle the $2,100 in a new manner. You configured an automatic transfer to move the money into your Fidelity account on the morning your paycheck cleared the bank. You kept the same day of the month and the same habitual rhythm while redirecting the destination. The automation removed the need to make a conscious decision while the cash sat in your checking account looking spendable. You directed the first portion of the funds to capture the full employer match on both of your 401k plans. You collected the free money that the mortgage payments previously prevented you from claiming. You funded both Roth IRA accounts up to the $7,500 limit for the current year. That specific ceiling used to feel like an abstract concept and now functioned as a simple line item in your budget. You routed the remaining cash straight into the identical brokerage account that rescued you in the Harris Teeter parking lot. The account balance grew with clear intention. The money no longer existed as a random accident of circumstance. You kept the Honda Accord and the engine kept starting most mornings. You started viewing the concept of a mortgage through a new lens. You stopped treating the loan as a source of terror. You started viewing it as a leveraged tool for future use. You planned to lock in a low-interest rate if you ever refinanced or purchased another property. You intended to build a brokerage account large enough to cover the monthly payment using dividend income alone. You would remain mathematically debt-free while technically holding the loan and never experience vulnerability in a grocery store parking lot again. Your invested money would work on the loan balance instead of your monthly paycheck fighting the debt. 8 months into this new automated transfer system, you and Hannah reviewed the actual account balance. The Fidelity application displayed a total exceeding $34,000. The balance remained far below the cost of a boat dock at the peninsula in Cornelius. The number fell short of the price tag on an Embraer Phenom 300E private jet you never seriously priced anyway despite looking at the specs online. The cash represented real liquid assets moving in the correct direction for the first time since you started chasing a zero mortgage balance. You spent 7 years building a stationary monument. You spent the first 8 months building a new foundation. That foundation supports your daily routine. You recall the physical sensation of mailing the final mortgage payment. You discard that memory as you walk through your day. You carry a different financial reality. A Fidelity account balance hits $34,000 on a random Tuesday. You ignore the notification. Your physical property generated $0 of that gain. The building occupies the same dirt and holds its standard market appraisal whether you monitor local real estate or ignore the market. You open your phone on a Sunday morning and spot the new account total. The screen prompts a financial choice that terrified you last year. You feel calm reading the numbers. This reaction proves your progress. You value the property deed in your filing cabinet less than your ability to make independent choices. Bricks and mortar fail to grant personal liberty. You face a central puzzle this week. Homeownership status belongs in the past. You select the deployment of your capital across your remaining years.